Inflation continues to be in check as we see the October Producer Price Index has dropped 0.5%, its biggest one-month drop since April of 2020. Inflation is down, oil is down, everybody's in a good mood, and what do you think happened? The stock market went up once again, our fourth day in a row that we're seeing gains. Welcome, everyone, to Buy, Hold, Sell. I am your trader, Todd Schoenberger, and I am joined by my friend and co-host, Tobin Smith, out in sunny and warm Scottsdale, Arizona.
I got a vest on, okay? It's not that hot.
You look sharp. You look very sharp with that vest on. We have a very special guest with us today from Defiance ETFs. She is the CEO and CIO. Sylvia Jablonski is joining the show today. Welcome to the program, Sylvia.
Thanks so much for having me. Happy to be here.
Love it.
Absolutely. Well, I got to say, Sylvia, you are everything you've said is really been working. Inflation is in check. As long as it stays in check, the markets are going to continue to rally in the short term. Is that the right forecast? And do you think that this is going to be continuing on through the rest of the year as well as into 2024?
Yeah, I love the you're always right. I don't know if you used always, but that's a good word to insert there.
Always right.
No, just kidding. Yeah, I mean, look, I think we have the Goldilocks scenario, right? So the CPI number was cooler than expected, and I think the markets really love that. And it was probably a big relief for the Fed as well. PPI was in line. There's a lot of reasons for that. You have the 10-year, below 4.5% as of yesterday. You have generally inflation cooling across the board. The price, oil prices went down and consumers remain kind of strong, good wages, things like that. Earnings are good. So really everything's lined up pretty well. I think the two wild cards in terms of could it kind of have a shift or a reverse of the good times rolling here could be geopolitics and any kind of head fake from the Fed. I think we were all expecting inflation to be either in line or maybe even a hotter read, mainly because we had that period of time with oil and whatnot. But this is really good news. So yeah, I think markets love it. The idea that eventually, maybe we keep rates where they are now, the Fed pauses, and eventually we get a cut there. This is really what the markets wanted.
All right, this is the PK meter, and the PK meter is when he jumps in my lap. That.
For the listeners listening to this show, you definitely want to check out the television program of Buy, Hold, Sell, because Toby has, it looks like, it's not a kangaroo, but what is that thing that you're carrying?
That's a cat, you bonehead. Okay, say hello to Sylvia. Tell that mean bald man to F off. Okay, all right. Well, Sylvia, I think it's intriguing. The inflation, there's only like one real chink in the inflation number. And I don't know if anybody saw this, but for some reason, it shows that health insurance prices are down 25%.
Yeah, which is bizarre, right?
And they're trying to explain it because of different times of payment. But wouldn't you just smooth that out? And why would you include it in an index since it's such a, it's the largest part of the United States economy? Because at least for my subscribers and people who are in my trading rooms and stuff, I got a lot of conspiracy theorists, okay? And that was the first thing they wanted to talk about in the morning is how contrived and manipulated the inflation numbers were. But on the other hand, year over year is how we do this. And I think people sort of forget about that. And year over year, just, good old CPI, not even CPE, it was 9%. 14 months ago. So it's the rate of change or the rate of change to me that matters. And I think that's what the market is starting to realize is that just as all those elements took inflation up, we had a guest on yesterday was a big monetarist, and she could not understand how I wasn't talking about how all the money pumped into the system was inflationary. I said, well, that was monetary inflationary, but that had nothing to do with price necessarily, but it had to do with the supply demand being out of it. But once you spend that money and buy your new iPad or your new apartment, you've spent it.
Yeah.
And so, a lot of that spending power has come back to earth. Yeah. And the Fed is actually selling bonds and not buying bonds. So you would think that would be an impediment, but in fact, gravity, financial gravity, remember that? Finance 101? Yeah, it still works.
Right. And,
Yeah.
and Sylvia, in her notes, had put in there that this is the time of year that we should be seeing that sticky and tricky inflation. I'm not sure if it's there anymore, though. It seems that everything is cooling off, and it's cooling off fast. And I think that's where you have this optimism from traders that we might actually see a possibility. We might see Fed rate cuts in 2024. What's your thought on that, Sylvia? Do you think that we may see cuts next year?
I think that the Fed has more or less done what he said. The way that he talks about it changes, right? Whether or not, I think he was pretty dovish in October. And then, in the last conversation, he almost had that twinge of hawkishness when he kind of talked about head fakes and things like that. So, there's always a wild card, right? Because I think they don't want it on their heads if they kind of cut too soon, right? I mean, that would be the biggest disaster for his reputation after after the transitory thing and then kind of fixing it, right? So I think that if anything, they'll be conservative about that. But I'm probably in line with the dot plot, right? Maybe they'll have 2 cuts next year, wait it out, pause it out now, see how it goes, see if you have those 2 cuts next year, and whether they come in March or kind of later on remains to be seen.
Todd, I'll tell you that what's another intriguing thing is, if you ever met Jay, no one calls him, he's Jay Powell, but nobody calls him Powell.
Well, you guys are tennis members or some tennis players or something. So
at the Congressional Country Club.
And JP, anyway, what's going on?
Keep him low.
Nicest guy in the world. But he was a history major, for crying out loud, at Princeton or Harvard or whatever, one of those fancy schmancy schools that Todd's boys go to.
Boston College.
And so, man, if you're like a history major and you get a degree in history, then the last thing you want to do is F that up, because it stays in the books forever. A, and then B, he made his money as a front man for private equity firms. He was never an economist. He was, what in the private equity business we would call a suit. He had 12 suits. He made lunch reservations and dinner reservations for prospective clients and or to woo money. And that was it. He wasn't involved in policy. So I am very impressed of what he's been able to put together. He's obviously a very bright person. But he did not want to be the Arthur Burns of the 21st century, that's for sure. He's a little bit older than I am, but he was around there when they prematurely cut rates. And then secondarily, he was going to err on the side of being too lax versus being too restrictive. Because I just go back to my theme of the last, 36 months. There is no playbook here. There's no playbook for having free money for 12 years and then have that stop. Then having your mortgage rates go for the mortgage I have is 2.25%.
Amazing.
Somebody bought a house like down the street. They're paying 7.75%.
Sucker.
Well, what's amazing, just even in the near term, right? We all sort of, I didn't really cheer, but I felt that when you saw that 10-year go below 4.5, it was like, yes. It's like, what?
Yeah.
You know what I mean?
Yeah.
And
we're just slightly above it today. We actually rose 9 basis points in the 10-year. But here's a question for both of you, though. You still have Jay Powell comes out and he still is holding on to that 2% target. What do you think, Sylvia? Do you think we'll ever see inflation hit 2%? And if that's the case, what happens if we don't? Then all of a sudden, this could continue on. At least the threat of hiking rates again could continue there. Or do you think that Jay Powell might come out one day and say, you know what, guys, I think we're good. Inflation is close enough to 2%. We don't have to worry about it. Let's move on with our business.
Yeah, I think it's the latter. I think it's they get close to, right now it's his weapon, right? Because he can kind of read the data, take it in for the next couple of months, make sure that the decision is the right one, and use that line like, if he raises rates again, right? I told you it's got to be 2, it's not 2, right? So I think that's his kind of like get out of jail card if he raises rates again. But my sense is that it's going the right way. If it gets somewhere between 2 and 3, I think most people are going to be pretty happy with that, and he'll probably readjust and start rewording that things are feeling a little bit better, without addressing the fact that
Well, Todd, I
a hard number.
That the common knowledge here is that if you were to come out and say, like, for instance, what I would say if I was in this position, well, if 2% is our inflation goal, then the first thing we have to really understand is, how did we stay below 2% inflation for a decade and a half? If we don't understand that, then how can we understand the reverse of that, which is, well, 2% really is somewhat arbitrary, given that almost all the dynamics that kept inflation so low that we couldn't figure out are now going away geopolitically, population-wise, energy costs, yada, yada, yada. But the argument always is that if he comes out and says, all right, listen, we're done. He just got Jewish, by the way. We're done, okay? Then the bond vigilantes are going to jump in and say, middle finger, big boy. You said it was 2%. We made all our judgments based on the goal being 2%, and we're just going to sell the crap out of those bonds, which then, of course, makes the interest rates go up, but to the biggest payer in the world of interest, the federal government of the United States. And I just did a number, Todd, recently, that when you replace the 2.25 10-year bond tomorrow with a 7 3/4, not 10 year, but a 4.5% bond, but for the 30-year, and it's now 5.1. Can you do some quick math on that, on how much more interest you're paying? And then all of a sudden, the federal government is paying more in interest on the debt. And I don't even talk about the $2 trillion that they can't, figure out what to do with, that have to borrow anyway. But it's going to be bigger than the defense spending. It's going to be big, so now we're truly the country that has a standing army, an insurance company, and sells debt. That's the business of the federal government. So he's stuck, I think.
Okay. Yeah. All right. Well, there you go. Well, we're going to leave it right there, guys, on this block. Toby, are you having an earthquake there or something? Your screen is popping.
No, PK's trying to get back up in my lap, and I'm shooing him away.
PK, there you go. All right. Well,
he's just like Dad. He's a TV whore. It's horrible.
Very good then. Well, we're going to leave it there on this block, because coming up next, we're going to ask Sylvia what her favorite stocks are, some of her favorite investments. You're going to be shocked about which tech stock is her favorite, but you definitely want to hear about it after the break. There you go. Look at Toby. He's on the edge of his seats. So with us today, we have Sylvia Jablonski, CEO and CIO of Defiance ETFs. She is joining us out of New York City today. But we will be right back after the break. Please stay with us.
Buy, hold, sell, brought to you by Crosscheck Management.
Girl, it's been way too long. I got to get back in my zone. Hey. 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 All right. Come on. 3, 2, 1. I'm feeling too good to be cooped up. Hey, ladies, don't we look good? We came to have a good time, baby. I'm feeling too good to be cooped up. Me and all of my girls, we gon' tear it up.
Ready for business
in brief?
Bloomberg Briefs puts the power of Bloomberg to work for you with over 15 industry-specific newsletters available only by subscription. Each offers proprietary data, researched and written by acknowledged experts. Top analysts, dedicated economists, senior business editors, all presented in a concise, uncluttered environment.
It gives me the edge I need.
Go to BloombergBriefs.com right now for your free 30-day trial.
What does it mean to be a leader?
It's taking my first solo flight.
At the University of North Dakota, we lead our own way.
Stock market rallied again today. Inflation is in check. We saw the producer price index come down and actually dropped 0.5%, the lowest 1 month reading since April of 2020. It's wonderful news because it says the Fed has things under control. At least it seems that way. The optics appear that way. and stock market is rallying as a result. Today with us, we have Sylvia Jablonski. She is the CEO and CIO of Defiance ETFs. And we also have Tobin Smith and PK, who is our official mascot of Buy, Hold, Sell. But PK somewhere, but maybe we'll be making another appearance. Sylvia, I want to ask you.
He's my trader during the day. He's a gray cat.
There you go.
He loves hitting the buy signal.
Well, on the Bloomberg, absolutely. All right, well, Sylvia, I got to ask you, because I really, if you can just give the audience a little bit of information on Defiance ETFs. It's a fascinating story. I know there's a Hollywood connection as well. Maybe you could tell everyone about it.
Yeah, sure. So our chairman and the original founder of Defiance is the grandson of the Belsky brothers, which, who are famous for essentially rescuing 1,200 Jews during the war. There's the Hollywood connection is essentially Daniel Craig and Liv Schreiber have the movie Defiance, which is about his grandpa and uncle. And so, kind of heritage, legacy, wanting to make kind of the family proud and do something, disruptive, different, defiant. The name of our company is Defiance ETFs. And, to that effect, our strategy is essentially to kind of do two things. We, number one, we kind of want to disrupt and innovate, right? So we thought about the future of technology and we launched a quantum ETF, which is like AI and machine learning, the future of communications, 5G, we've got electric vehicle stuff. And then, most recently we've looked to turn some of these cool enhanced income products on their head and disrupt there and come up with some pretty cool ETFs that do that as well. So
pretty cool is not touching it. Let's tell the real story. I own a number of your ETFs.
Yes.
And these ETFs, Todd, exchange traded fund. I know you're new to this. This thing's paying out 5% a month in dividends. Yeah. My clients think that it's a mistake. And so can you tell the audience simply, how in hell do you deliver these incredible yields? And oh, by the way, as the stock market goes up, the actual ETF goes up in value, even though it's paying out 50%. I mean, it's nuts.
Yes. It's so I think some of the more popular products out there that people know about, do things like invest in an index and then call it S&P 500, right? And they get like a 1.5% div yield, and then they do some covered call writing once a month, and then they generate some premium for that. So they get like their 1.5%, and then whatever they gain from the call work that they do. And so what we figured out is that there's a way to potentially generate more income by kind of turning this thing inside out. So about a year ago, 0 DTE, so 0 days until expiry options were listed and launched, right? And so these options expire in a day. So they have, kind of massive premium, massive time decay volatility and all that. So we figured out that if you sell slightly in the money puts, with 1 day to expiration, essentially, you can generate an outsized premium, and you can do it every single day. So more.
And you're selling puts. You're not selling calls.
No, not selling calls. So we do it a little bit differently, right? So we look at 60, 70 delta puts, slightly in the money or at the money puts, essentially on a daily basis. And, the other cool, I think, leg up that we have is, there's no kind of like derivative use. There's no leverage or anything. These are super clean. What we do is we start in the account with cash and treasuries, right? So treasuries are yielding 5%, well, now 4.5%, call it, but still better than 1.5% on the S&P, right? So you have that. And then every day we deploy 90% of that cash, sell the slightly in the money puts, gather the premium, and we do that every day. And essentially at the end of the month, so far for the past 2 months, I think month one on QQQY, which is the NASDAQ Enhanced Income Fund, we're able to do an annualized div of 62%. The second one was 67 on JEPY, JEPY, which is S&P 500, over 50% both months. So the idea is clients are comfortable with risk for sure on the equity. Like you have exposure to, if NASDAQ is down, you're down, right? If S&P is down, you're down. But if the index is kind of flat, slightly down, slightly up, you're capturing a little bit of the performance and all of the premium. And that's,
I'll tell you this, Sylvia. For managed account clients that I have, it has to be with someone who's sophisticated enough, I think, to understand just sort of the idea of it.
Yeah,
but more importantly, and more importantly, they have to be experienced enough to say, you got to think forward 3 months here. The actual ETF is down, 2%, and you just make the payout, and we reinvest the dividend if you don't need the income.
Yes.
Then now you have Charlie Munger's snowball machine.
Yeah, I'm so glad you said that, actually, because that's the one thing that people miss. You have to reinvest the dividend. I mean, you'll probably be fine without it, and you'll get some nice income, and especially if the index is up. But if you reinvest at least a large percentage of the dividend, you're still like the results are just stellar over time. So that's actually a big point.
Yeah, I actually did some. I didn't do it. I just talked to Chat BRD Google, and I say write some code for me to show what happens when you reinvest 5% a month.
Yeah,
and it goes in, assuming that there's no increase in the actual underlying index, and after 12 months, you can't spend that much income. I mean, it just keeps rolling and rolling. All of a sudden, your $100,000 is now 150. Then the next year, your 150 is 300. Yada yada yada.
Yeah.
And I only do these in Roth accounts or IRA accounts or 401k. I don't do it outside because now you're going to have to pay taxes on this stupid income. But in a Roth, where you don't get to deduct the money you put in it, but the money you put in and the income you get is mostly tax-free unless you're making, Todd Schoenberger income. Then it's the Charlie Munger, invest $1,000, every other month for 50 years. But if you did it in your stuff, you'd be so stinking rich that you would just quit after 25.
Yeah. I mean, look, like I hope so. And I think that you're making a lot of really good points, right? I think the first point is that this is
not a pretty face. Okay?
Boring enough and clean enough to be in a retirement account, right? A lot of pushback that we get is like, these are naked calls, you're going to be put the stock every day. You're not put anything. These are cash settled index options, right? There's never, you're never put stock. And then, the second point is about the taxes to keep it in the Roth, but the reinvestment is just absolutely key, because you'll get outperformance anyway. Like if you run QQQY versus Qs, you can see that it's outperforming Qs. But if you reinvest it, it's kind of game over. And if you have anybody who wants charts, I mean, we have loads of math on that.
I love it. Well, trust me, you're now my new best friend. But let me tell you the other issue is that that sells it, if you will. You actually want the market to go down for 6 months. In other words, you're not afraid of a bear market, because as the index value, you're getting more shares in the index.
Yes.
And stock markets are cyclical, et cetera. But with the caveat that I'm not talking about 2007, 2010. I'm not talking about, real bear markets, 50% downdrafts.
Yeah.
But still, if you were 45 and you had that fund in 2008, and now you get into, the teeth of a 55% down bear market, the income you're making today, insane. And obviously the Federal Reserve, created this environment where stocks couldn't go down when they made free money. So I think you have to temper your expectations, of the real world. But we still have the Fed put. Yeah. And if something happens, look at Silicon Valley Bank. Shocking that they jumped in 5 days and saved it. I mean, downside risk is a lot less than upside gain.
Well, and just to explain that too, for anybody listening, right? When you have days that the NASDAQ is down, 1.72%, our fund is down maybe 1.3% because we gathered that premium. So you're actually kind of, people say, oh, well, puts are used to hedge. We're not using the put to hedge. We're using it to generate cash, and the cash is, the cushion. And then on top of that, it's earning, kind of what the treasury rate is once it's in the account too.
Right. Which today is now for less than 2 months. 10 years ago, right? So I mean, now you're getting 4 times more risk-free yield.
Yes.
So, which even makes it. If you need a spokesman, I'm your dude. Now I'm telling you right now.
And look, I mean, a lot of people it's been out
for the wholesaler.
2 months, and we've gathered 230 million in assets. It's just been, the growth has been just insane in these funds. And
I saw
talking offline about
those numbers.
Quick question. these are put options
Yes.
on index futures. So are they trading on the CBOE, or are these
So
listed?
these are put options on the index, right? On NASDAQ, on S&P 500, and on Russell. So they're the only ones that actually exist right now, and they're
Okay.
on yeah, they're on CBOE.
Okay. Let's pivot out of this one though, because I have to ask you. I know that you follow the tech sector
Yes.
quite well, and I know NVIDIA has always been one of your favorites. But I was actually surprised when I was reading your notes that you really like Microsoft.
I do.
And yeah, so explain to the audience.
Microsoft is not funny. I'm sorry, Sylvia, it's not funny.
It's not funny. It's not funny. Look, I mean, just the kind of like the boring answer is it's a solid company with a strong balance sheet that, over time will appreciate and whatever. But I like it for so many reasons. I think last year was down 44%. You're starting to see, PCs pick up. People are starting to upgrade, do all that stuff. They're winning on software, but it's the AI thing, right? They have this new 365 Copilot, and 40% of the S&P 500 is using it. So they're actually a company that, we're talking about AI in their next earnings call, they're going to have a line for AI, right? And not to mention the OpenAI investment, just crushing on earnings. I just think that, NVIDIA is the winner in chips for sure. And then I think Microsoft is going to be the winner on the tech side in artificial intelligence. And,
let's not forget
maybe
that
we'll see what they do with their own chips too. On
I was
top
going to say, they just introduced their
they
own
just announced
chip,
that whole thing. So we'll
slightly
see.
less computational, but they don't need, here's the strange thing. And so I've been deep into AI for a long time. And what was different about ChatGPT and was about NVIDIA was that H100 was doing 4.5 trillion calculations per second. I can't even get my gigantic cranium around that. But you only need the 4 trillion calculations while it's doing its learning, and so once you've actually built the LLM, you don't need that guy. And so that's, to me, I'm a big Microsoft fan as well for a couple other reasons, is because they're doing like what Google, I have longtime friends at Google, the AI guys, they all sail around the world in their 747s, like smoking cigars and having booze. But at Microsoft and at Google and at Amazon, if they invest, $1 billion in AI, that AI company uses their data centers. And if you look at the price of the data centers that they're paying, particularly, AI, OpenAI, I'm sorry, dude, they're going to spend $300 million on data center, and there's no cost of acquisition. There's no commission to pay anybody. So it's 100% incremental income.
Yeah,
they're taking money out of their $180 billion of cash. So really, what is $1 billion? When that $1 billion is buying you $250 million of revenues, that is all incremental profit. The math is unbeatable.
It's unbeatable. And they seem, some of these, what I liked about this earnings season is some of these guys, and Lisa Su on AMD, they seem to actually now have, kind of concrete insight into their next earnings season and revenue growth and things like that based on, demand for chips and the orders that they're seeing and all that kind of stuff. But it's just phenomenal. I mean, I think that everybody, it was so exciting when the announcement came out about, OpenAI and ChatGPT and Microsoft and all that, but it was just kind of like hype then. And now I think people are starting to realize, like, wait a minute, this is the real deal. This is going to, kind of digitalize factories. It's going to make self-driving cars work, EVs work, all of these medical records that are in a black hole that, can't help doctors do their research, cancer research, that sit in a big, computer somewhere in a closet in the middle of the country. I mean, this is the stuff that's going to change the world, right? Once it starts working. So, I'm super excited about it.
That's great. That's great. And one other
So
sector.
when does the Microsoft ETF come out?
I don't know if somebody has one already. I think somebody's
I've seen there is one.
Yeah.
But if you're the spokeschild for,
they don't have
Microsoft.
ODTE though. They don't have so the issue is, right, and we're going to do all sorts of stuff with this, but it's only the 3 indices that this exists on. So we have IWMY. That's the one we just launched like a week ago.
Yeah.
But as soon as these come out, you know, I'm sure you're going to get more movers. I mean, so many people are excited about these products. So
I love it. Well, I'm
it's
short.
cool, right? We
I'm
finally
short. I
innovated.
was short Russell 2000 for a long time, and we flipped over
Yeah.
like I think everybody else who has half a brain. And
Yeah, now's
Man,
the time. Now's the run for that, right? Now's the run
Yeah.
for that. So
yeah. Wow.
Get that right. I know, right? It's great. It's fascinating stuff. So let's pivot out of this before we close out the show. I want to one sector we rarely talk about is travel and leisure. And you seem to have you seem to be a fan of the airlines right now. So
I know. Totally.
yeah, is it just based off of the Thanksgiving travel forecast, or is this something that maybe investors want to look at for next year?
Yeah, I mean, I think airlines, cruises. So we've got an ETF that has cruises, hotels, and airlines in it, right? And the cruises were really epic in the first 6 months of the year. Carnival, you know, Norwegian, some of these companies were up 60%, 100%, you know, whatever. And you know, granted, off of you know,
big lows,
pandemonium post COVID, but the airlines are interesting, right? I think they got the rebound. You know, you started seeing bookings go up to what they were, you know, close to what they were pre-COVID. China opened up in January, so you know, east-west connections, things like that. People out there for business. So that's kind of the story. But why I like airlines again, you know, when first you have Russia, Ukraine, and now we have you know, what's going on in the Middle East with Israel, Hamas, and all of a sudden, you know, you worry about airlines, right? Like oil prices and people aren't going to want to travel and all this kind of thing. But then I think in the near term, like if you look at the last earnings announcements, that every CEO said that demand is hotter than ever. Everything's going well. They're charging higher prices. Consumers have wages. They can pay for them, pricing power and all that. And then they were sour on the outlook because of the price of oil, right? Because of geopolitics. And so now look, oil has fallen again, right? So I think they're going to be getting some, you know, relief from that. And I think in the next 55 million people are going to travel supposedly this week or next weekend, I guess, for Thanksgiving. It's just, I think it's going to be a good story into the end of the year, and it's kind of boring and nobody's looking at it anymore. But I don't think that they're going to get hit with the geopolitics risk now, at least.
Yeah, Todd, I mean, the oil prices obviously are down. The airports are, you know, jammed every time I fly out every other week now down to Southern California, and oh my God. But
yeah, I mean, I paid more for a ticket to go to Florida for Thanksgiving than I could for go to Paris a year ago.
Yeah, but look at their costs. Look at the new pilot contracts. Look at the new student. Their cost per mile is about 18 to 22% higher than it was this time last year, and the price of diesel fuel or jet fuel is not near hitting that. And if you look at my most hated airline, well, Spirit is my most hated airline, but very close to that is Southwest.
What?
Unless you investigate which plane they're flying, because if you get the 737 Max, it's got the big overheads. It's got the Wi-Fi actually freaking works, and I'm flying them down to Burbank on Friday, but their earnings power was really generated on the Deltas and the Americans and the people who are flying to Europe. That's where, do you know anybody who's been to freaking Venice recently? Or to...
Yeah, I do. I sure do.
Oh my Lord.
Yeah.
So those rates, they've been paying through the nose.
Right.
And,
yeah, but they're doing it.
And people are paying it because they, as Todd, I've only said this 500 times, the top 25% of income in America is 76% of discretionary spending. And all right, so it's $800 versus $1,400. All right, I want that number 2 business class. I'm not going to pay first class, but I want that lie down. And so they're selling that out. When you sell one of those seats, that's like selling 4 seats back in steerage back there. So I was more impressed, but I'm out of them simply because A, we got out of them because we wanted to get out of them. B, a lot of them are down 30-40% from their highs. And then
that's what I'm in when they're down 30-40% off of their highs. I think they get a little tailwind into the end of the year, and then
all right. Well, we'll have a bet on that.
I'm definitely not that's not my long-term trade, right? Like I'll have Nvidia, I'll have Microsoft in my portfolio forever. airlines I'll, play around with in the short term, because I think like even Target. I mean, Target is a stock that I bought, and then they kind of like, and I kind of hate the story, but I just think that, with like people stealing everything and locking everything up and all that kind of stuff. But like, I mean, people are just spending their money,
Todd, you have to
a couple
understand.
months for that.
You have to understand. Todd has been sitting on that stock for a year and a half.
He has every reason to. I mean, it's that the whole strategy is just like ridiculous. But I mean, they cut some costs, and people are just spending. I think it's a good, marker of consumer discretionary, and you saw it this morning. I mean, I hate what he's saying about like, oh, people come because they know everything is there because it's locked up. Like, what? You know what I mean?
Yes.
Right.
Yeah,
Right.
It's
We only-
American
money
actually.
there,
We only use handcuffs on guests who are of different color skin. That's what he basically was saying.
Right.
Oh,
There's
wow.
all
I'll
sorts
tell
of
you one,
bad
though.
stuff going on there, but people are spending money there. I mean, that's
Yeah. What I'll tell you one that I
I'll be
like
out of
is
that
Lind.
one too by the end of the year, but I think it'll have a little tailwind.
Well, I like Lind, L-I-N-D. L-I-N-D is a very high-end ocean operator. We've been to the Galapagos on them. We've been, in other parts of the world. There's only 220 suites. There's no kids.
Yeah.
You have, day adventures that are unbelievable. I have a picture back here that is just of, the penguins in the Galapagos and and stuff up in Alaska. Anyway, they just got crushed.
Yeah.
And they're now getting into their season, and I look at how much their pre-sales are, and they are really almost pre-sold for spring and summer for next year. It's a $6 stock today. I think it's worth $11 to $12 when they start putting these earnings on there. So I'll throw that one in.
Okay, that's a good one. I like that a lot. Well, these are all great ones to consider, and just some super names actually out there for the investors. I know they're going to get a lot out of that. So, Sylvia, I think we said it all today. What a great show. For the audience, you want to go to Defiance ETFs, ETFS.com, and check out what Sylvia and her crew are doing there.
And next time the market takes a dump, go to that site and buy the QQQ, or the JEPY. And then don't look at it for a year and reinvest the dividends. That's all I'm saying.
There you go. That's some great advice.
You're hired. You're hired.
All right, done.
He's the head wholesaler, that's for sure.
He's
Absolutely.
the head.
Absolutely.
I'm definitely the head. I don't know about that.
So, Sylvia, thank you so much for taking
Thank
the time
you.
today to join us on Buy, Hold, Sell. We love to have you back on and follow up on the discussion.
And next time you have a new one, we'll have you on the show because we want to be the first financial media to tell the story.
Fair enough.
Absolutely,
Fair
especially
enough.
with us going live on Apple. Absolutely. So listen, on behalf of Sylvia Jablonski and Tobin Smith, I am Todd Schoenberger. Thank you once again for joining us today on Buy, Hold, Sell. We'll catch you next time. Take care.
Buy, Hold, Sell, brought to you by CrossCheck Management.
I want you to smash that like button.